Hello and welcome to the AthenaX live stream. My name is Neil and I'm your host for today. Today we've got a very special guest here. Matthew, welcome to the show.
Hi.
Quick one. Yeah, thanks for introducing yourself, Matthew. So for a quick one, Matthew is with Coinwatch. Coinwatch is one of the world's leading market makers. Matthew, for our audience who doesn't know who you are, please tell us a little bit of Coinwatch and a little bit of background for yourself, please.
Sure. Just a point of correction. We're not a market maker. We are a marketplace for
Marketplace.
projects to find a market maker. Think about it as like a kayak for flights, right? You don't go on Singapore Airlines or Delta Airlines to find the flight. Usually you go on kayak to find the best price. That's kind of what Coinwatch is for market making deals. That's the first business. That's called Coinwatch RFP. And the second business is called Coinwatch Track. And it's about tracking the work of your market makers once you've hired them, once they are market making your token, and to keep tabs on what they're doing, how much volume, what kind of bids, what kind of offers across what exchange, and verify that indeed they are delivering the work that they promised.
Super. So I'm super sorry about that accident
All good.
with the classification, but I think kayak as a marketplace for market makers is a pretty interesting concept, especially in Web3. I remember that I was doing a little bit of research on you guys, on yourself, and you've got quite an impressive finance career. You spent 9 years as at Barclays as a derivatives trader. You a director, and I think for most people they would have stayed at a job, but you decided to leave that and to start Coinwatch. So I think it's a little bit crazy, but at the same time it's a very it's a very brave move. So what was the reason you decided to jump into Coinwatch? What was the reason or the special sauce that essentially made you have the confidence to leave a stable job?
Well, it's true that back then it felt crazy. It feels really good today. So after 9, 10 years of trading, and I was kind of grown through the ranks of the trading floor, and was managing a team of derivatives traders. I was 30, and I realized that I was kind of bored at my job. So my specialty, the underlying asset I was trading was WTI and Brent, so crude oil. And I just couldn't hear about pipelines and refineries and VLCCs anymore. It just was too much. I was not interested in it. And I was 30. I had saved some money, as a trader for a long time. I was single, no kids. So I'm like, look, you have some money in the bank. You can afford to take a chance for a year or two to explore something else. And so why don't you do that? And you're right. Back then I was making 7 figures and a super safe job. I was at the bank, not at a hedge fund. So the bank for traders is kind of like being a teacher in in the school system. It's hard to get fired unless you really, really suck.
Yeah, I mean,
And
you're doing
so
oil as well. It's not easy to get into.
No, exactly. These seats are far and few, but I found that it was not a good enough reason to stay. Like these golden handcuffs felt just, too tight. Oh yeah, and one thing I had going on for me was that the oil market closes at 2:30 p.m. in New York. Every day at 3 p.m. I was on the street, quote unquote. So I had a lot of time to explore and to learn. And so that's how I came across Bitcoin. I was just reading and I thought, oh, maybe I should start, computer science studies to become a coder because it seemed interesting to me, even though of course the salary would never be the same. But anyway, and so I came across Bitcoin, and that was 2018. And I thought, oh, wow, this is extremely interesting. This cool technology. And I thought, okay, I want to work in crypto. I want to be part of this thing that's called Bitcoin. So either I put all of my savings into Bitcoin, which is really dangerous, or I quit my job and I start working into crypto. I buy a little bit of Bitcoin, but not quite as much. And so as a trader, the thing that you learn is risk reward, right? And so I'm like, okay, if I buy all of the Bitcoin, I can stay in my job and I'll still be exposed to crypto, but it's mega risky. Like if this thing goes to zero, back then Bitcoin was at $3,000-$4,000, started to come up, but not very much. I would have been in trouble. And so I should have done both. But I only joined crypto. I quit my job. I joined crypto. I didn't buy as much Bitcoin as I really should have. But anyway, yeah, the rest is history.
That's never
So
enough back
no, it's
then.
never enough. Exactly. But yeah, back then, I started my first job at CoinList, which was, I mean, I'm sure you guys are familiar with the name. And I was a product manager. I had no idea what I was doing. I was a product. I didn't even know what a product was. As a trader for 10 years, the only thing you know how to do is buy and sell and make markets. And so it was pretty rough. And of course, my salary had been divided by like 7 or 8. So I'm like, what the hell am I doing? I'm in the same city. I'm still in New York, but I feel like a lot poorer. What is that? And my friends, of course, were like, what are you doing, dude? Like, just join a hedge fund if you want to trade something else. Join another bank. So yeah, that's the start of my crypto journey.
Wow, what an interesting story from New York, hitting the trading desk for oil, and then jumping into CoinList. Was CoinList the only crypto job that you had, or did you go further?
Oh, for sure. As in, at first they were the only one interested, and honestly, still, I'm so grateful to them that they took a chance on that random trader dude who was interested in crypto. So after CoinList, after 2 years at CoinList, where I really got the feel for the adrenaline you get when you build a product that hits PMF, that happened to me twice at CoinList, and it felt amazing. One of them was a centralized wrap Bitcoin interface, which back then was the first one. So CoinList was the only place where you could bring a Bitcoin and withdraw a wrap Bitcoin and vice versa. Now it's run of the mill, but that business within a year was 5 million AR for the firm, really because it got built before DeFi summer. And then of course we captured like all of the flow because we were the very first ones. FTX replicated it a few months later, but yeah, we had greenfield for a while. And then the lending market at CoinList, which before BlockFi blew up, it feels good when you build a product that people use and the same rush that when you trade, and you're right, except it lasts a lot longer because the product is a business. And so it's not like a trade that does well. Are you closing it? Are you not closing it? Are you taking money off the table or not? You're constantly grappling with these questions as a trader. When you build a business, it feels a lot better because there is no scenario where you want to shut down the product. You want to switch it, you want to maybe tweak it, you want to improve it, but shutting it down, that's crazy. And so that once I got that emotion, that feeling, there was no going back. So after CoinList, I was hired by Coinbase to lead their institutional interest rates products. So both retail and institutions, basically anything for retail to be able to earn a yield on their assets. Unfortunately, this was Gainsbow's days, and the SEC came down on Coinbase pretty quickly after I joined, and that's public. So my job as a senior PM leading a team of PM at Coinbase to build these products became super horrible because I spent my time with lawyers. I'm really not good
Oh,
at that. So I left Coinbase, unfortunately, fairly quickly because I wanted to build. And I joined Dapper Labs. And at Dapper Labs, which was back then, one of the hottest company to work for in crypto, like fresh off the hills of CryptoKitties and NBA Top Shot, to work on NFT liquidity. What would that look like? How do you go from an ecosystem of millions of NBA Top Shot moments and build a real market with transforming them into fungible assets, really? Unfortunately, the rug was kind of pulled from under my feet because the marketplace was just worsening month after month. And after that, that's where I started to build Coinwatch. But yeah, I'll stop here for a sec, maybe.
no, like it's interesting because when you tell me your career path, it sounds like you were always like at some point one step ahead of the curve, and then you jumped into Coinwatch. And I think it was just last year there was a pretty big scandal. There was with I think it was called Next Fund AI, which was essentially like a fake token launched by the FBI. And then once again, because you were creating this marketplace for market makers, and then I think it wiped out about maybe like 70 different market makers on the market at that time, right? So once again, you're dealing with the Fed in some case. So no. So maybe let's talk a little bit about that. When that investigation started happening, what went through your mind? What was happening behind the curtains then?
So I think the FBI stumbled upon or really baited a very specific and particularly murky corner of the crypto market making ecosystem. And I really wouldn't want you or your listeners to think that this is representative of all of crypto market making. It's not. And thankfully, there is a term to describe that murky, seedy area. It's called active market making. I want to just caveat this conversation. Active and passive market making is not a thing. It does not exist in TradFi. You will never hear BlackRock or Citadel or Goldman Sachs talking about active or passive market making. Active market making is a term that was pretty much created by this, gray area of market making, like, the Web3 port and the Godbit and, some of the names that are in these FBI
Yeah,
announcements.
very famous names in meme coins, especially those.
Exactly. Exactly, in meme coin. And the promise of active market making is alluring. It is, hey, you know what? We do things differently. Passive market makers, they just make markets. That's not ideal. They put bids and offers, but it's not really what you want. What you want is active market making, which is price management. Active market making really is about price manipulation at the end of the day. They can, it's a nice little wrapper. They can call it whatever they want, but at the end of the day, the promise is we're going to protect your price. We're going to manage your price. And there are many recipes to do that. This is not that these guys are better or smarter. It's just that they put in place trades and instruments and an environment where it's much easier to manipulate the price. It starts with low circulating supply. Of course, when you have few tokens out there, it's much easier to determine the price than when the thing is heavily traded. So that's what the FBI with this fake token really, baited these market makers to come out of, the shadows and to distribute their service. And I've seen these decks so many times from so many of these shady market makers about we can do things better. We can manipulate your price. In TradFi, if anybody was making that pitch to an IPO company, they would freak out. In crypto, because people are not as used to, financial markets necessarily, or what is illegal, what is not, the promise sounds alluring for any founder. Wait a minute, I can hire these people and they guarantee me that my price is going to go up. That's awesome. Why would I not sign them? Of course, it's an empty promise. It never, ever ends up being that. But there is enough founders out there and enough gullible and small protocols that the promise at some point hits, someone signs, and of course, we know the end result. It's a token that goes very low very quickly.
Yeah, and I remember going to one of these events. I think it was Token 2049 in Dubai, and you would see these people who were dressed very loudly. They were screaming new rich. Essentially, they were wearing designer clothes, Versace head to toe. But the craziest part is that they actually had jewelry that was like as thick as like the kind of chains that you would use to wrap around a gate of like a factory, right? And when you go up to them and you talk to them and you find out, oh yeah, I'm a market maker. And then you start asking them, like, how did you get so much money? And I think with the FBI coming in there, yeah, like I think it was only a matter of time. And I think it was just a crazy period. But because your business, you essentially aggregate market makers. How badly did that affect you?
Zero. Basically zero. And because at Coinwatch, we, for better or worse, our clients rely on us to do some filtering. Meaning we need to be able to, the marketplace that we created. So today we have 44 market makers on the marketplace and 22 market makers on Coinwatch Track, which is our tracking product, which allows us to see in real time what market makers are doing. A lot of market makers want to be a part of these two products, right? Because there is a lot of deal flow going through Coinwatch. We negotiated the likes of Monad and Layerzero and Sui and Aptos and so many more projects. Any market makers, active or passive, want to get access to that deal flow. But the thing that they are up against is essentially the fact that for 10 years, when you work at a bank, especially when you work in trading, you get hammered with compliance trainings. Hammered. Every quarter, you have to spend hours sitting presentation or scrolling through PowerPoints that teach you what is good, what is bad. And the reason is simple. When a bank is caught doing something bad, something that approaches active market making, of course, not as bad as that, but in that direction, they can get fined billions of dollars. So for the bank, it's very important for the bank that their employees know that you should not do that, right? Because they cannot put a cop behind every trader. So they have to teach you. And so because of that, I have a very strong sense of right and wrong when it comes to financial markets, at least as defined by the SEC, the CFTC, and these bodies, right? So when I hear these promises, active market making, I smell 1,000 rats, right? So these guys are not welcome on our marketplace. They're not welcome on Coinwatch Track, simply because we know that these guys that don't have our client's best interest in mind. What they have in mind is extract as much money as possible from that gullible client. And look at Movement Labs. You don't have to look very far. Web3 Port was taking 50% of the proceeds of the sales that they were doing for Web3 Port. That's absurd. And so I don't even
criminal.
want to be in a discussion with these shops. It's criminal. It's criminal. I don't want to be involved, not even for Coinwatch potential legal exposure, but just because I know that it's BS, right? And these promises of price go up are BS. And unfortunately, some of our competitors, especially on the advisory side, thrive in telling projects, oh, with us, your token price is going to go up. And invariably, it's never the case. And invariably, there is always a next client who's going to buy into that BS. It's very unfortunate, but that's part of Coinwatch mission, really establishing standards and shining a light on this really murky industry that is yet to be regulated, that is crypto market making.
Right, right. So you preach a lot about transparency, and now we understand why it's important. I was thinking, which are the projects that are essentially looking for transparent market making? I know this might sound like a silly question, but is transparent market making essentially only a service for businesses operating at a certain level?
That's a very interesting question. I think in general, all projects want transparency from their market makers. Because when you put yourself in the shoes of a founder, a market making deal should terrify you because you're lending from a few basis points to a few percentage points of your total token supply to a hedge fund. That is scary. That is scary. Hedge funds, if you walk on the street and ask someone, what do you think of hedge funds? You have a good or bad impression of them. Nobody's going to say, oh, these are friendly entities. No, they're not. They're here to make money. If it's at your expense, doesn't matter. They're here to make money. So these market making deals, they represent a lot of assets and the potential for damage is large, meaning a market maker who's not responsible and who does not really care about the client's well-being can take that loan and sell all of it. And you don't have to spend very much time on crypto Twitter to see conspiracy theories, plenty about these projects. So a bad market making deal can not only yield no work whatsoever in terms of liquidity provided, but it can actually be way worse. It can hurt your token and send it to zero extremely quickly because the hedge fund, the market maker, has more tokens than anyone else in the market. So their potential for hurting you is large. So everybody wants transparency. It's just that in crypto, until really Coinwatch Track came about 6 months ago, the status quo was, well, I've got two choices to know what my market makers are doing. Either I'm going to connect to the market maker own reporting system to see what they're doing, or I'm going to use some aggregating entity, competitors of us, but that will show me self-reported data from market makers. So pretty much the same thing. Basically, you had to trust the numbers that the market makers were sending you. That's not ideal, right? Market makers' own platform, they're going to show you the numbers they want to show you. If they don't want to show you the number, oh, sorry, we had a bug yesterday. No data to show you. Come back tomorrow. Right? They control everything. It's their system, right? How can you be sure that they're showing you the truth? And of course, self-reported data is something that we use to support as well. It's literally a spreadsheet that the market maker sends you and says, today I worked very well. Today I traded a lot, right? You can write anything in that spreadsheet. People have been used to that. So just like, when you go on an EasyJet flight, you're used to having a horrible seat and you cannot recline, you have no TV. You're used to that. So you're not going to complain. Same thing with market making deals. Except until we shipped Coinwatch Track, which is a very innovative technology because we connect directly to the market maker API keys to receive real-time data about their trading behavior, trading volume, bid offer spread, depth, streamed on all the exchanges where they have a mandate. And so all of a sudden now the alternative is you can go from that self-reported once per day, if you're lucky, data to real-time, trustless, with one counterparty that standardizes everything for you, and that's Coinwatch Track. So we see now a lot of demand from big projects. Mona just announced a couple of weeks ago that they were using Coinwatch Track to track their market makers, and very small projects, because guess what? Any project should have the right to know what their market makers are doing with their tokens. Now, there is one category of projects, to answer your question, that is not interested in that. It's projects that do active market making. Yeah. And I'm not gonna name names because spend some time on Cointelegraph and CoinGecko and you'll find a few. But these guys, they don't want transparency. On the contrary, they want everything to stay very, very murky. They want everybody to think that this is a normal market. Everything is fine. These are not the joys you're looking for. They don't want the flashlights. On the contrary, they hired people to really have this little, murky thing manipulating the price. So they have no interest in turning on Coinwatch Track. And yeah, we don't know about them. They don't want our tech, and that's fine. There is many, many, many more projects want to do the right thing. So business is growing still.
Love that reference. Not the droid you're looking for. It's hilarious. So from what I'm hearing, Watch Tracker essentially it builds this trust layer for a lot of projects out there. One of the things which, in my experience in B2B deals as well, even though that you do have the data to essentially back up the trust that you are bringing to them, it's often the soft skills that really push the deal through. So I was wondering, because you've definitely been in these conversations in these rooms, what are some of the key components that serious projects or maybe even institutions look out for when it comes to market making?
Well, that's a very interesting question. And it's actually probably the most diverse part of my job. So as the main point of contact to all our clients when it comes to deal negotiation, because you need a lot of context, you need a lot of data. So it's always me. I never ship that to a Coinwatch employee. It's extremely interesting because different teams have different angles. For example, a brand new TGE token, Monad, Double Zero, Plasma, recently, these guys are going to look for different things. For example, the stress on one team might be, we don't want the price to go too high. We don't want the price to go too high because otherwise it's going to break our chart. It's going to make us look bad. Another team might say, we really need to sell $2 to $3 million of tokens in the first week because CapEx is going to be an issue. We didn't do any fundraise. We didn't do any ICO. So we need that cash. Another team might be, okay, we don't need that much cash now, like we're not in a difficult situation, but I need at least 100K a month. How do I do that? Through my market making deal. And so it's a very, very broad spectrum of things. But in general, at the bare minimum, they know that we need liquidity. That's not a question that usually teams were like, okay, why do I need liquidity? I just show them some Coinwatch Track data. For some tokens, market makers are 80 to 90% of the order book. That means that without that market making deal, singular or plural, your book would be 10 times less big. Why does that matter? It's not just for your ego to open Binance and, wow, it's very liquid. No, it's because if you have an investor or a liquid fund or a team participant, a community participant, a validator, what have you, anybody who wants to interact with your token, before they think of buying it, they're going to think of, okay, in what conditions am I going to be able to sell it? If the slippage, meaning the cost of entering or leaving a trade, is 1, 2, 3%, it means that if you go in and you pay 2% and you go out, you pay 2%, you already need 4% of price performance to break even on your position. Why would I enter a token like that when I can enter a competitive token where the slippage is only 40 bips, right? Or 20 bips. So liquidity is extremely important. Projects know that also because if liquidity is bad, projects are going to delist, which happens, more often than not when liquidity is bad. Having good liquidity is one thing, but there are a lot of ancillary things that you can do with the market making deal, such as selling tokens indirectly via short-term options, such as making your CapEx safer, also making the trading volume higher, right, by having shorter-term options and longer-term options. So a market making deal is something extremely flexible, extremely dynamic. And my background as an exotic options trader, so when I was trading options, I did very complicated options at first and then very vanilla, very simple options afterwards. But so this ability to structure an option, to use an option and to tweak it and to make it more exotic, to tailor the need of a particular client, that's something extremely useful that we can do in crypto.
Okay, let's do like a lightning round. If let's say it's an institution who, they've been in TradFi for like 5 years and they want to get into crypto, they want to establish a DAT. What is their needs for a market maker?
If they want to establish a DAT, typically the DAT is going to be traded on a TradFi exchange. And so they will not need a market maker to market make on the DAT. Typically, it's through the exchange where the DAT will be traded. The exchange itself will have a deal with a market maker. So that will be easy. If they are doing the other way around, meaning they take a real world asset and they tokenize it, what Securitize is doing, or there's a lot of hype around RWAs these days, and stable coins to a degree is the first RWA. That's where a TradFi entity needs to hire market makers to come in and provide liquidity. That's all the bank stable coins that you see, right? You can go on a few exchanges. There are lots of USD-backed stable coins. They are doing the same thing. But if you want an exchange to list it, if you want your user to use it, you need it to be liquid. If you want it to be liquid, you need a market maker. And guess what? When you hire a market maker for stablecoin liquidity, typically the market maker is going to be paid a retainer deal, meaning 5-6 figures per month. And that retainer deal ideally is correlated to how much work they do. So imagine you're a bank and you issue a stable coin, and now you have to pay market maker ABC a ton of money, and you don't know what they're doing. The only thing you know about their work is the self-reported data they give you. That's not great. Enter Coinwatch. Now they can use Coinwatch to see the exact truth about how much volume they're trading, what bid offer spread they're maintaining on that stable coin, what kind of depth are they that they promised me they would have, what are they actually showing in real time on all these exchanges. And so our product is a big unlock for this TradFi company because now they have a source of truth for the work of their market makers that was not available before.
Okay, I got you. Now that's like the institutional bit, but let's talk about another segment where there's like a mode of like startups, right? And those are the startups that are at the small level trying to scale up into the mid-size. What essentially are those companies should look out for when they look for a market maker?
Absolutely. That's a very interesting question because as I said earlier, a bad market making deal can do much worse than not do anything for you. It can hurt you. It can actually doom your token. entirely. So the one thing that projects want to think about is how much liquidity do I need? Before you start to think of, oh, I always get asked, what is the right deal size? How many % of supply should I lend? Now, before you answer that question is, well, how much liquidity do you need here? Because you're going to have vastly different needs if you're only listed on KuCoin and Aerodrome than if you're listed on Gate and Maxi and BitGet and a few DEXs, than if you're listed on Hyperliquid Perps and OKX. So you have a spectrum. And really what you want is your market making deal to be sized according to how much liquidity you need. That sounds pretty normal, right? If you want to fly from Paris to Singapore, you're not going to buy a round trip to LA and then just pay for a crazy flight and then jump out during the layover. No. So you pay for what you need. Understanding what you need is pretty hard. And so there is a whole cottage industry that got built, right? Market maker advisory. Coinwatch was the first one. I negotiated the first Solana market making deal back at CoinList, back in 2019. And we got a bunch of companies who did copy paste on the process, which is essentially, what liquidity do you need? Once you know what you need, marketplace, right? The Coinwatch RFP marketplace, where we send the need and we say, hey, market makers, quote for us how much assets you are requiring to provide that liquidity. Get the quotes back. And then, of course, we hold the hand of our client to understand, okay, what quote is good? Should you sign a retainer? Should you sign an option? What makes sense? And really, if you want to have it super high level and to simplify, if you're a small token who's not going to be listed on many centralized exchanges, let's say Gate at best, nothing higher than Gate, so like Gate and KuCoin and Maxi, nothing more, then retainer deals might be more appropriate, because a retainer deal has vastly less power to hurt for a simple reason. A retainer deal, you have no option on it. And so the market maker cannot just willy-nilly sell your token, because if the token explodes, well, they're going to have to explain what the hell is going on. Whereas an option, the market maker can sell everything. The market rallies, well, they have the option, so they can, they're protected. They can buy the tokens at the strike of the option, regardless of the price at which they sold. Small tokens, small launch, DEX-only or DEX plus a few exchanges, go retainer, go small, right? Like 50, 60K of liquidity streamed by the market maker. For unit of liquidity, you need at most 3 to 4 times unit of token, right? So if you want $1 of liquidity in a book, you need to lend $3 to $4 to the market maker. Max. Okay. Now that's for the smaller guys. For the bigger guys, and this is really bigger than, say, you get Gate and you get BitGet and Bybit and the bigger guys. Now you have a different problem. How much dollar of liquidity do you want? Anywhere between $500,000 to 2, 3, 4 million, right? Depending on what exactly liquidity you want to get streamed. And now that ratio is going to go from 3 to 4 to 2 to 3, right? Because there is more liquidity, there is more volume. So the job of the market maker is easier. So they require a smaller payment. And usually you're going to switch to an option deal at that point in time.
Wow. That was superb advice, Matthew.
Great. I hope it was clear.
Yeah, it was clear. I'm really impressed because I think for a lot of listeners who are watching in the audience, right, I think this has actually been very helpful for them to guide their thinking and planning out their market making strategy. Let's talk about retailers, right? So some of these guys, they're just here to trade, right? They're just here to speculate. And the thing is that some of these can also be new entrants into the market, right? What is a tokenomics or market making that you see in the wild that instantly you tell yourself, or yourself, you tell yourself inside and say, this token is doomed, right? this project it's not gonna go far. So how would you spot these?
So on the tokenomics front, it's hard because look, you can make a number of mistakes on your tokenomics, but if you have a diehard community, if you don't do something completely suicidal, like have massive unlock of your investors too early on, etc., the tokenomics can actually take a back seat. And quite frankly, I've never seen a tokenomics shop, a specialist of tokenomics advisory, unearth the tokenomics that's like the holy grail that, now finally token price improves. No, token price is ultimately supply and demand. And so as long as you have demand, even if your tokenomics suck, if your community loves you and they really like your token, well, it's going to work. That's meme coins, right? There's no tokenomics behind, but it can still very much be very high in price. Now, the one thing that I'm always extremely nervous about is when I see clients, good projects, solid projects, who become frustrated by centralized exchange listing teams. Frustrated by the fact that decentralized exchange listing teams, unless they are big, they're not necessarily going to be super, friendly. They're going to say, hey, no, either we're not going to list you, or we'll list you when you have 500K Discord users, or 500,000 Twitter followers, etc., etc. And so these teams, we've had clients, right, that we took through market maker advisory. They're still yet to be listed because exchanges are like, no, later. It's not your turn yet. It's not your turn yet. And they end up thinking, okay, I'm going to go DEX only. I'm going to go DEX listing only. And I know this is not popular to say, oh, if you go DEX listing only, careful. People love to think that the world is on chain and you don't need centralized exchanges. Screw KYC. Let's just go DEX only, right? And it's true. That's the promise of crypto, that everything will be on chain. But for better or worse, even the most sophisticated, the fastest DEX on-chain exchange is Spot, Hyperliquid Spot. It is still a very small exchange. It's smaller than KuCoin. Hyperliquid Spot is tiny, 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 tiny. So when a project tells me I'm going to go DEX only, this is what happens more often than not. Sometimes that's not the case, but more often than not, that's what happens. They launch DEX only. Great. There is maybe a liquidity pool. It trades a little bit. Community is happy because they can finally either sell the tokens they receive or, now there is a price, right? So they feel validated of having spent time on that protocol. Usually the trading volume is going to start to go down because the DEX is not super visible. You're not tapping into a lot of people to see and buy your token. And so the trading volume is going to start to go down, usually taking the price with it. Now, the project still wants to be listed on a centralized exchange. That's still the holy grail, to be on Coinbase and on Bybit and on Binance, etc., etc. Now, when these projects go to a centralized exchange and the centralized exchange says, okay, do you have a price? Yeah, we have a price. We are live on a DEX. And it's like, okay, so you're trading 50 to 100K a day now on your DEX. Why should I list you? Like, you realize the money opportunity here. If I list you, if I get your trading volume here, that's like $1,000 a day, $2,000 a day. Why the hell would I list you and give you priority over a new shiny project that has not listed yet? And boom, they're doomed. And we see some clients who want to ship a new token just to get a chance, completely useless token, by the way, but just copy and replace the token that already exists in the DEX, just to have a chance to be new and fresh again on centralized exchanges. So that is something I caution teams a lot against. It's like DEX only listing and launch might seem alluring because it's fast. You don't have to pay. It's straight away. We're not in a world yet where this is a solution that is as valuable as going with a centralized exchange in terms of trading volume and penetration. So if you decide to do that, know that it's going to be a super steep hill to climb later on. Some projects have done it. Dog with hat, some memes, meme coin, but by and large, 99% of the time, you're not going to be able to do it.
This actually reminds me of, actually maybe not reminds me, but kind of explains to me why so many of the initial tokens that came out during the DeFi summer, they no longer exist anymore because they never listed on the centralized exchange.
Exactly.
And I think it's a precautionary tale to plan your token out because it's a product at the end of the day, and every product needs a product strategy in order to be successful.
That's exactly it.
Yeah. Matthew, so quick one then. You shed so much alpha for institutions, mid-tier, small tier projects. And obviously you have seen many problems in the market, especially with market making. What is the maybe one thing that you wish could change within the market making industry?
Wow. the list is long. The list is long. Look, we've come a long way. We've come a very, very long way. In 2019, when I negotiated that first market making deal for Solana, the status quo was, first of all, there were three players: Wintermute, GSR, Jump. That was it. And the status quo was lend an absurd amount of tokens, 5, 10% even. Compound famously lend 10% to Jump, right, for their market making deal, with a strike price at previous round valuation, right? So not even like TWAP at launch, just like 10 times cheaper than that. And don't ask questions. We'll do the job. We'll provide the liquidity, right? When I was at CoinList and I started to create that marketplace, right, which is now Coinwatch RFP, but back in the day it was a spreadsheet, right, and me in front of a computer, Jump was actually really, really pissed at me. They were like, look, because of you, we're losing deals when before there was no problem, because now you're asking us for KPIs. Now you're asking us for what are we going to do with that 10% of supply? And I was kind of shocked. Like I was just out of a bank, right? So I knew what market making was. And I'm like, well, if you're going to get paid 10% of supply with an option crazy in the money, doesn't sound insane to me that you're going to commit to some kind of work. And that was anathema for Jump. I was like, no. Now things have changed a lot. I'm still a pain in the butt of Jump and some other market makers, that wish Coinwatch didn't exist. But now the quite frankly, the steady state is, okay, you are going to get KPIs. They're going to be signed in the contract. be signing the contract. And for the KPIs that you're asking for, which is the liquidity you're requiring, you should lend your market makers 2, 3, 4 times this amount, right, to the loan size. So if you want a lot of liquidity, you're going to lend a lot of tokens. If you want less liquidity, you're going to lend less tokens. And that's now pretty accepted. That's through the work of Coinwatch, and through all the competition and all the RFPs we've done, and really pushing the standardization in the market making industry to say, this is good, this is fair. And it's really on us to draw that line. And we draw that line well, and we get to draw the line, not because I'm a nice guy or because I'm a knowledgeable guy. There are plenty of knowledgeable guys out there in the market. We get to draw the line because we have clients and because we have big clients. Just mention a few, right? From Monad to Morpho to Sui to Aptos to Layerzero and many, many, many more. I've negotiated north of 350 deals since I'm in crypto. From back in the day, Filecoin and Solana and Celo and Algorand and Flow and so many coins. And so because we have these clients that trust Coinwatch and that run their market making search through Coinwatch, we have a lot of power to establish these standards. Because what we tell market makers, the passive, which is our bread and butter, and also the active who want sometimes to see what's going on and join the flow, you have to follow these standards. You have to be a good entity. You have to be a team player with these clients. Otherwise, you're going to be ejected from the marketplace, which has happened in the past. Some market makers have been taken out of the marketplace because they were misbehaving, because they just wanted the loan and the option, run it to death, trade it to death for the first few weeks, and then never market make again the token. We're like, that's not acceptable. That's not the business, right? The business is about market making for a year. And so yeah, it has been a long road. We're still far from over. Really, the next thing I really want to see is Coinwatch Track and the ability to track your market makers being universal. No longer being a question which market maker are on track or not. Is everybody should be comfortable showing their activity to their client, not through their own platform, to Coinwatch. And we still have 3 market makers who refuse to do that. And we say, no. We have our own system. We'll never do a trustless reporting real time. We will show data. We will show to our clients what we do. They'll have to trust us once a day, once per week. It doesn't matter. Our system. These names are Selini, Wintermute, and Jump. 22 market makers are on Coinwatch Track today. Susquehanna, IMC, Galaxy, GSR, Flow Traders, Amber. These are big names. IMC, Susquehanna, Flow Traders, massive TradFi names. These firms accepted to be on Coinwatch Track and to let us see their activity at the API key level, not because it's comfortable, not because it's profitable, but because it's good business for them. Now they can tell their client, look, we're so good and so trustworthy and so ethical in what we do that we're comfortable through a third party, trustlessly, to show you our trading activity. The industry as a whole has to ask the 3 remaining market makers who own quite a big chunk of the market share of the crypto market today, what do you have to hide exactly? Why are you not on that system? They tried many excuses. Oh, regulation. Oh, no, it's too complicated. Oh, no, it's not privacy preserving. But after 22 of the biggest market makers in the world integrated to our system, these excuses kind of fell apart. And so now they stopped trying the excuse. Now the excuse is, we have our own system. Don't worry about it. Trust us. Really? Really? Should you trust them? That's the question that the crypto industry has to ask itself, I think.
So you're already working with so many of these big companies, but I don't think you're anywhere stopping in the next couple of years. So maybe I might just ask you this question: what does success look like for Coinwatch?
That's a very, very interesting question. Coinwatch started off as an advisory business, literally me and a spreadsheet. And the advisory was, hey, Flow or Celo, come here and I'll help you. Instead of you having to be on the phone with 5, 10 market makers, I'll do that work for you and I'll help you pick a deal. Fast forward to today, we have about 45 clients. We have 5 engineers, full-time engineers working on a trusted execution environment, the API key system essentially called Coinwatch Track, that is really industry defining. The business down, the advisory business is reasonably small. I only pick a handful of clients a year, the biggest names, the most interesting team, because it gives power to Coinwatch to establish these standards. It's also intellectually extremely rewarding for me to work with these teams to understand where the puck is going, what new deals we can think about together. The system, the business now is in Coinwatch Track. Coinwatch Track is honestly, for having been a trader for 10 years and having looked at a lot of trading systems, a lot of them, and not just because it's my product, but Coinwatch Track is insane. It gives you a degree of transparency and understanding of what's going on in your order books as a protocol that is unheard of. Even in TradFi, it doesn't exist. It just doesn't exist. And so Track is amazing, and it's probably my most rewarding experience of PMF. Built successful products in the past, but this one is It's my baby, right? But we don't stop here. Tracking is good, but really the question we keep facing is, wait a minute, what clients want at the end of the day, they want help negotiating a deal. They want help tracking, but do they just want help or do they want us to do it for them? And that's the next iteration. And that's called, we don't have a firm name right now. We're toying with some ideas. Maybe you'll have better ideas for us. Coinwatch Autopilot, for example. The idea is Coinwatch is in the middle of the relationship. Projects lend tokens to Coinwatch with an option or with a retainer. They decide. And then Coinwatch takes that loan, slices it up in pieces, lends it to market makers. Then we run a constant competition on these market makers. We have the data. We know how to look at the data. That's our system. And so 24/7, we make sure that the market makers are working as hard as they can, providing as much depth as they can. And if they can't, the market maker is terminated and replaced with someone else. We can do that very fast and very efficiently because we are onboarded with all the market makers. We have the system. So for the project, it's one contract with Coinwatch and that's it. We turn around, we can cycle through 22 market makers very actively. Literally, I mean, we could do it on a daily basis if we wanted to because we are signed and onboarded with everybody without the client having to know it or even care about it. And this really allows us to be a smart liquidity router. We take a token and we find the market makers who are the most active with it, the most effective with it in real time. If they stop being that effective and active, goodbye. And we send it to either the top market maker on that leaderboard or a new market maker, part of the 22. And so that for me is the natural next evolution of our business, where we really manage the assets of these foundations to provide them liquidity with no headache, no dozens of contracts to review and relationships to manage and settlement of assets. We take care of everything. We take care of everything. And then, of course, the next natural evolution after that is prime brokerage. When you think of what is a prime broker is simply a service that institutions use to access the market, to trade, to lend, right? So Coinwatch is in a very unique, interesting position because we have a relationship with all these foundations who trust Coinwatch with their one of the most impactful things that they do, which is a market making deal. Why stop here? If a foundation wants to do a liquidation program, why not trust it to Coinwatch? I was OTC trader for 10 years. I can do an OTC liquidation for any foundation. Case in point, we do the WorldCoin execution on a daily basis. That's public information. Lending, they want to do treasury management. They want to lend their cash. Why not trust it to Coinwatch? We're in the market. We have access to all these counterparties. So that's extremely interesting, and it's a natural evolution of our business. It's much easier to do than what we've been doing because trading OTC and lending market, I've built these things in the past. It's not super hard. We know once you pass the regulation standards, and then of course there are lots of other things we can build. And I don't want to give too much away, but we have now these data pipes between 22 of the biggest market making firms in crypto. Why only getting trading data through it? Why not prices, executable prices? So these are just some of the things that we look at, but certainly there is a lot of room to grow. And that's why I love building in crypto. There is just so many opportunities out there because it's still the beginning of a big story. And yeah, it's just a pleasure and an honor to be able to have a product out there that clients of this caliber are using and enjoying.
Super exciting stuff, what you have planned. I even may have heard of you might be building an interactive brokers for crypto. And I think that's one of the most successful brokerage products out there in the market. But with that said, we have come to the end of the show. Matthew, for the listeners, 2 questions. How can they follow you? And also, what is the final words for them?
Absolutely. So follow me on Twitter, MattJob1 or coinwatch.co. Final words, just be careful out there. A market making deal is, it's like a good impression. You usually will only be able to do it once. You might renew it in a year if you're lucky and your project is still around, but think hard before you trust what market makers tell you, especially things that sound way too good to be true, like price management and forever up only curves. Sit down, have a think. Does it really make sense? Ask them for examples, ask them for references, because these clients usually are not repeat clients of these market makers. So don't do anything crazy. If something sounds crazy, seek the advice of either ourselves or trusted counterparties like investors, for example. And yeah, again, tracking your market maker should be normal, should be standard. You're paying them a lot of money. You should, and you have to ask them for proof that they're working. That's just standard. So here if you need us, and we have a form online if you're interested in our services. So don't hesitate. And I hope today you guys learned something.
Thank you so much, Matthew, for coming on board for this episode of the AthenaX live stream. Once again, this is Neil, and we are a purely financial entertainment and not financial advice. Thank you for tuning in, and I'll see you at the next live stream.